Okay,
Good
so
morning.
I'm going to ask Ruth to share her screen now, and we're going to start talking about business structure and how you can make it work more efficiently for you. So over to you, Ruth.
Okay. We'll start. Why is it not starting?
Everybody else, if you go to start slideshow, that's it. And if everybody else can mute your microphones, this will only be, I think we're going to be about 30 minutes in the training, aren't we? So if you put questions in the chat, we'll hold on to your questions for afterwards, and then we'll come back and have a discussion around everything that Ruth is saying once Ruth is finished.
Sorry, Emma, could you see what I was just presenting?
Yes.
Good. Oh, right. Okay, I'll just start again.
Again. Yeah,
Sure.
Perfect. So, okay, right, I'm going to go on mute now as well and speak to you later. We can see that well, Ruth. It's all good. You're on the partnership slide. You okay, Ruth? You're going through the slides.
Yeah.
You're playing the slideshow.
Can you not hear the music?
No, we can't hear anything.
Oh, well, don't worry, let it run, it'll be fine.
Okay.
Well, that was interesting because there's actually a really nice piece of music that goes along with that. So sorry about that. That's I thought I had that all set up and ready to go. But anyway, so this just gives you a bit of an idea in terms of what we're going to be going through and the differences between being a sole trader and being a limited company. So what are the advantages of being a sole trader? Well, firstly, it's very easy to set up. The important thing to say about being a sole trader is a sole trader is you. There's no difference between you and the business. So of course you can just start doing some work, set up. And as the slide said, all you've got to do is tell the revenue that you're doing it and register for self-assessment, and on you go. As a result of that, you have far fewer legal obligations. You don't have all the paperwork and all the setup and everything that you might get into a limited company. And you also, importantly, all your money can go through your own personal bank account. You don't have to, whilst it might be, I would advocate having a separate bank account, it's not necessary. One of the other advantages is that you can take money out whenever you want to. It's your money. It belongs to you. As a a sole trader, you are not, again, you're not a separate business. So your money is yours. And as a result, any of your income or anything that comes into your business is treated as income with, or taxed with income tax, rather than any corporation tax or whatever. Another second advantage then is, if you make losses, say when you're setting up your business in the first year or so, you're not doing quite so well because you're developing your business and you've got trading losses, you can offset those against your personal tax. So you're reducing your personal tax bill. You can make use of the £12,500 tax-free allowance. So as a small sole trader, it's quite tax efficient. It helps you in your first few years. You have greater privacy. In incorporated businesses, one of the things is that absolutely everything is in Companies House. All your accounts, all your details, your shareholders, your paperwork, everything is in Companies House. If you're somebody who just wants to get on and be a small business, you don't really want people to know your business, know your financial situation, let's say, then being a sole trader is an advantage, because you don't have to publish any of that sort of stuff. And then at the end of the day, it's a lot easier to close the business. You just stop. You don't move forward. So what are the disadvantages of being a sole trader? This is the biggest one, the unlimited liability. So if anything goes wrong, it's your neck on the block. It's your assets, including your personal assets. It's your house, it's your car, it's everything you absolutely have. There is no protection between you and your personal asset, or between the business, sorry, and your personal assets. It's a really big issue. If you're in an industry where there might be contentious situations, there might be contentious clients, etc., then even if you're in a small business, then I would recommend being a limited company. It does give you that structure and that certainty that you can protect your own personal assets. So yes, you can lose your personal assets if things go wrong. If there's a court case or whatever it is, then as it says, the liability that you have is unlimited. Tax. Having said that tax can be kind, when you get bigger, tax becomes less advantageous than it would do in a limited company. You start to be taxed in a much stronger way, because you're being taxed in a personal tax regime, which of course, once you get to a certain level, you're taxed at 40% and you've got national insurance to pay. So it can be less kind than being a limited company. All taxable income, as I say, is subject to income tax and national insurance, just as though you were an employee for somebody else. And again, as I say, that can go up to your 40% level, or whatever the tax regime is at the time. This is obviously, it goes hand in hand with the unlimited liability insurance as a sole trader. I mean, insurance is important anyway, but as a sole trader, it's absolutely critical. But it can be hugely expensive. If you want to somehow try and protect your liability through insurance, or mitigate your liability through insurance, then obviously that can be a great expense to a small business. Raising finance. This, if you imagine as a limited company, because everything is in Companies House, all your accounts are in Companies House, all the details are there, everything's visible, then a bank or a lender or somebody has more comfort. They can find out more about you. And by finding out more about you, they can get the confidence that they need to be able to lend you money if that's what they want them to do. As a sole trader, they don't know anything about you. They have no, you can give them records, you can give them accounts, but they have nothing on file. They have got nothing public they can look at. And so raising finance can be really, really limiting. It can be done, and there are plenty of people out there that will do it, but they might then want things like personal guarantees. They might want a further debt against your house. They might want all sorts of things that then make your potential for losing your assets even greater. So raising finance can be difficult. So again, think about where you want to be at the end of the day. Are you just happy just being yourself and just doing what you're doing? Or are you on a route that's going to take you to stardom, in which case you need to set up in a different way to start off with? Similarly, as raising finance, it could affect your chances of getting mortgage. So the thing about sole trader is to think, you, as I say, you are the business, you are the person. There is no distinction between you and the business. So if you're anything you do in your business will affect your personal life. So if you want a mortgage on your house, then because the money is going through because your business money is going through your accounts, or your losses are going through your accounts, that could very well affect how a mortgage lender might look at you and give you a mortgage. And then another one to think about is your client. And again, this is where it comes down to what type of business are you and who you're working with. You know, if I wanted a plumber to come into this house and do some work on you know, on some radiators or whatever, I wouldn't worry about him being a limited company. But if you want, as I don't know, an estate agent, or no, not an estate agent, sorry, a surveyor to come in and look at the house and give you advice, I might actually feel that I wanted him to be a bit more structured and a bit set up in a slightly different way. So again, it really depends on your type of business, but clients can be reluctant to engage with unincorporated businesses. Going back to the same argument, it's about, can I see who you are? Can I see what you've got? Can I see your track record? Do I know that you are who you say you are, and that you're going to be reliable, and you're not just going to be somebody who's going to flit off into the sunset? So then we have limited company advantages. Obviously, the flip side is also true. The company is legally separate from its owners. So there is a distinction between you and your personal assets, your personal wealth, and so on. And the liability, therefore, if there's anything that goes wrong in the company, it stops with the company. There are exceptions where directors can be sued for certain things, particularly in the area of health and safety and fraud and stuff like that. But in terms of normal trading, contractual disputes, it stops at the door of the company. It doesn't go to you. So it is a protection from you. Business finance is separate. As a limited company, you must have a business bank account. It can't go through your own bank account. And I'm sure none of you do it, but it's also important to say that it is not the director's personal bank account. It is not for the director. It happens a lot that you'll find a director will think, oh, I know, I'm a bit short this month. I'll take some money out of the company account. I just stick it down to director's loan account. That'll be fine. No, it's not. It's not the company. It's not the director's personal bank account, but you'd be surprised how often that happens. But you do have to have your own bank account. It does have to be separate. Huge advantage for a limited company is that your name is unique. Because you have to register it at the company's house, you can't have two names that are the same. And therefore, when you've got your name, nobody else can have your name. So that means your name is your name and it can't be replicated. It can be branded and you can protect that branding if that's what you need. That's not the case for sole traders. You can get lots of different names if you want to call yourself a company name. This is quite a useful one, actually. It's easier to structure ownership through shares. So what that means is that you can have, it doesn't have to be just you. It could be, you know, friendly family, or it could be friends or whoever it is who want to invest in your business and they get shares as a result. That means you can get investment into your business in different ways. You don't just have to have it from the bank. You can get it as investment in equity, where somebody will own shares in the hope that at some future point you might sell the business and they might earn some money out of the sale of the shares, or indeed that you're so profitable that they'll earn dividends. The great thing about shares is you can have different classes of shares. So one of the clients I was working with a couple of years ago, they had, you can name your shares, so they can be class A, B, C, 3, and you can have what they call alphabet shares, and they had got up to J in terms of the different types of shares that they had, and each one of those shares had a different right. So they might have a right to vote in a board meeting or in an annual general meeting, something like that. They might not. They might have a right to bid dividends. They might not. They might be just shares that only benefit on exit, or they might be a full-blown partner in that shareholding. And that's important to whether you're different classes of shares. It's important to put that together, because in a business, you have cut-off points of 50% or 75%. So if you want to make a decision in the ordinary working decisions in the business, you need 50% of the share capital to make those decisions. So say you want to take out a new bank loan, or you want to do set up a new type of business, you need 50% of the shareholding agreeing with that. If you want to sell the company, if you want to change the company name, if you want to do anything that's structural, issue more shares, issue rights issues, all those sorts of things, you need 75% of the voting share capital to agree with you. So when you structure your ownership through shares, you have to think about who's this person that's going to have this share, and are they going to vote with me or against me when I come to a tricky decision. It's really well worth thinking about. And you can get into very difficult situations where you've allowed an investor to come in and take, let's say, 40% of the shareholding, and then you're stymied. You can't do anything until you get that investor to agree, and their end game might not be your end game, and that becomes quite a difficult situation. But if you play it right, it can be really advantageous. So in that way, it may be easier to find startup capital, because as I say, it isn't just about getting borrowings from a bank or from a venture capitalist or whatever, but it is about bringing in seed money or equity money from other investors. For a limited, so then structuring that for growth is also easier. Deciding on what your structure is going to be. If you're in a limited company, you probably are there because you think you're going to grow. You're probably there because you think you're going to need employees moving forward, and having employees in a limited company is much safer than in sole trader. And so you can have your structure and your plan and your developed route to where you want to be. It is more tax efficient. There are lots of things that wider range of tax deductibles that you can put against your corporation tax than you can with your sole trader. It's much easier for the revenue as well. They allow that because it's easier for them to track what you're doing, because again, your accounts are visible, they get details of what you've spent your money on and so on. And then ultimately it's easier to sell, because you will have a company that will have a track record of its accounts. It will have all the information again on Companies House, in Companies House. It will have all the stuff there. So somebody who wants to come and buy your company can see what you've done. If you say this company is worth £1 million, they can see that it probably is worth £1 million because of the track record of what you've been doing up till now. So it is easier to sell, and it's easier to distinguish the company versus me, which you can't do as a sole trader. One thing I just put on, it's a bit random here, I've put it on the bottom here, but it's just a reminder that it doesn't matter whether you're a sole trader or a limited company, the VAT threshold is the same. If you are trading and you're selling products, you have to register for VAT if you get to over £85,000. Under 85,000 turnover, you can register. And again, it's worth then looking at, for example, can my client take on board an extra 20% because I have to add 20% to their bill? And is it worth it because I'm actually suffering 20% on a lot of expenses? If you've got no costs coming into your business, say you're a consultant, you've got very, very few costs, then actually registering for VAT may not be the way to go if you're under 85,000, because you're not going to benefit, you're not going to gain anything, and your customers are going to have to pay 20% extra. Disadvantages, obviously more responsibilities. You've got all this paperwork, you've got all the stuff you've got to do at Companies House, you've got all the stuff you've got to do with the revenue. You might have employees, in which case you've got to set up a PAYE scheme. it starts to get more complicated. You've got to have legal representation when you set up your shares. You've got to get all those rights. So as a result of that, it can fairly quickly be quite costly and quite time consuming. You are going to need accounting and Companies House filings, as I say, they're going to be more complicated. You will need an accountant to do that. You can do it yourself, but to be sure and steady and certain, I would suggest you have an accountant. And then you're looking at about £600 to £1,000 a year for that accountant to do those sort of base things for you, which they can do very easily. You can do it, but getting it wrong is not really where you want to be. Unwinding an error, either with the revenue or with the Companies House, takes time. Disadvantages, as I say, it's an advantage and it's a disadvantage is that your business information is open to all at Companies House. Even if you've got, say you've had a dispute with a creditor and you sadly have gone to court, you have a CCJ that's listed on Companies House, your covenants are listed. If somebody's taken out some form of guarantee because they've lent you some money, that's listed, it's all there, so it's all quite public. So it's worth thinking about that. Your fees are probably slightly low, but all these things stack up when you're starting out and you're just, you really haven't got that much money. And then obviously fees for incorporation just add on to it. And an advantage and a disadvantage is a separate business bank account, because again, that's another fee. Banks will charge you for a business bank account in a way that they don't charge you for a personal bank account. So again, I suppose the main thing with limited companies is the setup of the limited company can be costly for all these reasons. So a few other points just to consider. Forecasting and budgeting in any environment is really critical, because it's where do I want to be in 5 years' time, for example, and how am I going to be, how am I going to get there, what am I going to do next year, the year after that. And in this forecasting budgeting, it's not just looking at your actual trading and what you're doing, but it's saying, well, do I need investment in the future? Am I going to need a loan in the future? How is the best way for me to set up so that I can get the money I need in order to grow in the way that I want to grow? And then, of course, your forecasting and budgeting in any business, if you've got forecasts that you retain and you show, say you want to sell the business at some future point, and you've got your track record of your budgets, and you can show that you've had your budget 1 year and you met it, and you had another budget and you met it, and you had another budget and you met it, then when you're saying to the purchaser at the end of the day, this business is going to turn over X, they will believe you because they can see that your budgeting and your forecasting has been realistic all the way along. So having that track record is really, really important. One to think about, this is in terms of tax actually. If you're in a business which is very technology heavy, very asset heavy, tax advantages of capital allowances are very, very useful. And this is in the case of calculating your corporation tax. You will get capital allowances for any assets that you've bought. That can be really critical, depending on the business you're in. If it's a high technology business, that's probably a really good reason for going down the limited company route. Employees and contractors, just points to think about. If you've got employees, you will need a payroll setup, more fees. You can have an agency do it for you. It will cost something like £2.50 per person per month to do a payroll, but it's worth having that person. Sometimes payrolls are very, very straightforward, but then you'll get an odd thing thrown in, like someone's gone through a divorce, they've had a determination from the court, and the court has instructed you to deduct it from their salary, for example. It starts to get a bit more complicated in your payroll. You need HMRC scheme numbers. This is just more paperwork, really. And you need to be very, very conscious of IR35. If you've got people, if you think, well, I'll just have a bunch of contractors working for me, I won't make them employees, but they're working for me full time, they're not working for anywhere else. They are quasi-employees and the revenue will pick up on it. Paying yourself as a limited company, there are two choices. You pay, well, it's three actually. You pay wages, which reduce the company's profits, and therefore it reduces the company's corporation tax. You pay dividends, which is paid after the corporation tax. So you pay corporation tax at 19–20%, and then you pay yourself a dividend. The advantage with dividends, of course, is that the tax on you is only 7.5%, not 20 or 40%. And this is where it becomes much more tax advantageous. Of course, what's happened in the last couple of years is those people paying themselves dividends didn't get furlough. So, I mean, hopefully we won't go into that situation again, but it is worth thinking about. And often what happens is that people pay themselves partly wages, partly dividends. So they get, most importantly, they get their national insurance contributions counted in. Pensions, if you're paying yourself pensions in a limited company, you can deduct that against your corporation tax. Again, reducing your corporation tax bill, which becomes advantageous. And then again, this is just another little thing to think about, is making tax digital. If you are registered for VAT, you must submit electronically these days. So, and that doesn't matter whether you're a sole trader or a limited company, you have to have a way of submitting electronically. So it's a bit of a rush through. Actually, there's sort of more there than you could almost do another thing of getting into more detail in that, but hopefully that's been helpful. And if there's any questions, I'm happy to answer them. Incidentally, if there's anything that anybody would like me to have a quick chat with them at any other time, then please get in touch. I'm happy to do that. So thank you.
Thank you, Ruth. And just to say, I think that this is the right way of doing